On the podcast this week, if you've got a group of companies, you're going to really want to listen to this one to make sure that you're saving as much tax as possible. Welcome to the Profit Cash Growth Podcast. This is the podcast for 6 and 7 figure business owners who are looking to grow a financially successful business. My co-host, Claire Hancott, is a finance director, chartered accountant and entrepreneur. And every week, I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow and grow your business. So the problem with last week's episode is you're now inverting everything. So you said, what does a terrible husband look like? And I'm exposed. You've got the full list, haven't you, in your head?
Yeah, I figured it all out now, haven't I? I've had an awakening.
Everything Charlie Munger style now, aren't you, after last week's? Like,
flip it on its head and ask what really bad would look like.
Exactly.
And then it's easier to identify where you might be going wrong, let's say.
Yeah. Have you had any more businesses closed down this week? Not your businesses, like local businesses, like last week, or have you lost any more little gems that you love?
No, none of my favourite lunch stops, that's for sure. Okay. But I mean, yeah, I think in our town, the businesses are definitely closing down, and we seem to have I don't even know what the right phrase is, just like I can't get my head around how many Turkish barbers there are now in our town that seem to all be completely bucking the trend in terms of the economy and like have no problem whatsoever.
You know what they do.
Yeah.
Laundering
money laundering.
We covered a story on that a while ago as well, and I think they're onto them. Just don't know what to do about it. Okay, well, this week, let's not talk about negative stuff, because you forced me to put a positive story.
I did.
A news story.
I said all your news stories were so gloomy, and find a good one.
The problem is that is just news. Like they don't put out good news, but you found one, didn't you?
I did find one. Let's move on to it.
Let's see. So the headline is, British firms should not be shy about celebrating success. Now, ironically, when I've read this, Claire, you think it's a good news story, but actually it's not a great news story, because it actually just talks about how the UK is the worst at this in this survey. So basically, the story is that a survey has been done of 2,300 companies across 7 countries by Xero, the accountancy software company. And the study has showed that the 300 UK companies are the least likely to see positive patterns of patting themselves on the back, 55% versus the 71% globally.
So that's how many businesses celebrate success. So in the UK, we're saying it's only 51%, 55%, sorry, but globally it's around 71%. So we're obviously not very good at identifying good things in the UK. But why does it matter, Simon?
Very British of us, though, isn't it? Not to pat ourselves on the back, I think. But so probably not, maybe that's not surprising it's come out there. But what they have said is that it is really important to celebrate success, because what their studies have shown is that those businesses that go out their way to celebrate milestones with their staff and also growing their sales registered an average revenue growth of 30% in the past year, while the Shy Brigade only saw an increase of 19%.
Yeah, really interesting. So essentially, the crux of this is that the more you celebrate successes, the more growth you should have, logically. However, I would say that it's one of those, is it causation or correlation? And I think that's always what you've got to understand with numbers. Is it coincidental that these things are being seen as connected, or does one directly cause the other to happen? And I think it's definitely more likely to be a case of correlation than causation here, because I think it's fair to say that if you're a business that has a culture of celebrating successes and things like that, you probably got a slightly more experienced business owner that maybe has more of a leadership style and a leadership background, and therefore that's probably also making the business more successful, rather than any old business owner can just start celebrating every old success and all of a sudden their growth is going to go through the roof. Yeah,
absolutely. It's really interesting, because they said here that those companies who opted against ringing a sales bell or buying the team a drink or doing some other form of congratulation, 64% of those people said that they just never thought about doing it. Just never even crossed their mind. And interestingly, of those that did celebrate success, what do you think they spent on average in doing so in the last year? Random stat.
How much did they spend on celebrating success?
Yeah.
What, per person, or like?
It's just a number. I guess it's per business.
So no, maybe like £5,000?
No, it's not massive. £1,856. So they're not spending a huge amount on it. I mean, some would argue that you don't need to spend anything. You could just actually recognise success.
Yeah, bell.
I mean,
a trophy.
some gold stars on a wall work well, don't they?
I love a star.
Exactly.
Star shot, I'm one of them.
65% of the back slappers said that it improved motivation in the team. And 57% said it reminded them why they started their company. God, this is so warm and fuzzy, Claire. You've really pulled it out here, haven't you?
I'm glad that you're happy with my new story of the week.
But the problem is with the British is that they have the slogan, keep calm and carry on, don't they?
Yeah.
So we don't really put our head above the parapet and do that.
We just don't do it very well. We're bashful. Like, I know when I was a lot younger, even though I like a star chart, particularly when I was in my early career, I almost used to find praise slightly insulting because I was always seen as like a high achiever and sort of sat in that category. So when somebody pointed out that I'd done something really good, it was almost like, well, of course, like this isn't anything special. Like I do this every day.
I have that view though. Like this is kind of the challenge, like with managing people, especially kind of high performers. Is like high performers they often do need they need higher recognition, but they don't need sickly praise, because actually often they'll go, if you praise them for something that they don't see as being going above and beyond, they just see it as like, that's like what I'd expect anyone to do.
Yeah.
We talked about a guy one of my guys, didn't who just reacted phenomenally this week. His car broke down and
on a Saturday.
He just completely took full accountability for it. He literally said, damn, my car's broke down. I've already insured myself temporarily on another car and I'm getting somebody to pick me up and get me to my next appointment. I've already rang the appointment and told them that I'm running late. I was just like blown away. And this guy is on £10 an hour. He's not because I'm underpaying him against minimum wage. He's less than 21. It's his, national living wage for his age, but phenomenal attitude, phenomenal outcome. But again, when you try and praise that, and, say, I'd like to reimburse you for the insurance and various other things. Actually, I think those type of people, he pushed back quite a bit. It's just like, no, it's absolutely fine. It's like what I expect to do. It's just that's the way they're wired. And so you do have to be careful that you don't overpraise the wrong type of person, don't you?
When I look back my career and some of the things that I was being praised for, I was being praised for things that I felt were expected.
Yeah.
Or should or at the level that I felt that other people should be performing at, but maybe my manager hadn't seen that before. And therefore they're praising me, whereas I feel like this is the level that everybody should be at. But as I've gone further through my career, when you start to come up against things that are more challenging, that's when you do appreciate the praise. So I think when I look back, it's like, actually, I just wasn't being challenged enough. And if you're praising me for something that didn't challenge me, I'm like, come on, I could do that with my eyes shut. So what? Whereas when you praise me for something that did challenge me, then you really appreciate it. So I think if you've got somebody that maybe isn't responding to praise or feedback, a positive feedback and recognition the way that you think, and they're a bit of a high achiever or go-getter, maybe you're not quite challenging them enough.
True. And also it's quite important to really understand that person's value system.
Yeah, absolutely.
Isn't it? Because as I've said to you many times, I use the phrase, you're providing me with a service that I never asked for.
Yes.
Which means what, Claire?
It means that don't go to your house every day and do the washing up because you will never say thank you to me for it.
Because you're providing me with a service that I never asked for. So I don't i.e., I don't value it. So therefore, one side of the equation is thinking they're doing amazing things for me and you should be so appreciative.
Yeah.
Whereas the other side of the equation doesn't have that in their value system. So therefore, doesn't you put it where it needs to be.
And this harks back to where we very first got together, and I would come to your house and I would clean and I would make the bed and I would do the shopping and I would do the washing up, and I was like, you're so horrible. You never say thank you. And you're like, well, but I've never asked you to do any of that stuff. And I don't really appreciate that you've done it. And it's
and
complete misalignment.
It's the same with employees.
Yeah,
complete misalignment. So
it's a little bit like in a marriage. I think everybody's heard the phrase like love language, haven't they? What's someone's love language? Is it affection? Is it acts of duty? All of that type of thing. And employees, you've got to understand your employees' love language.
I don't know how you, whatever. We'll
without getting yourself in trouble.
It's not their love language, but their whatever their language full stop is, the language that they speak.
The
value language. We'll coin that. Language value language, something like that. Yeah. Okay. Well,
get a bell. Just get a bell in the office. Apparently, this is what this is. Just get a bell. Ring it every time somebody does something good.
Get a bell,
it'll be great.
And when someone does something good, just let them ring the bell, like you see on Selling Sunset and all that. Yeah.
Brilliant. And your revenue will go up. More revenue
11%.
growth. Just buy Bell.
I mean, I was pleased to see that in this survey, even if you don't show any recognition, you're still growing by 19%, which is pretty phenomenal. So I don't know what survey of companies have taken it. Certainly not Stratham's in our town, is it?
No.
But no. Anyway, all right. Well, we're back on tax this week. So let's talk about this week's deep dive, which is this tax rule for group companies. So, Claire, you're going to talk to us about this headline, how one tax rule can save your group companies pounds. And this is called SSE, which I have no clue what this means, Claire.
Yes.
Because you're talking technical language now. But you're going to educate us all today, aren't you, and tell us what SSE is and why it's important if you have a group of companies.
Yes, absolutely. So this is a real life scenario that happened over the last week or so in the practice. I have a client, we look after some of his businesses, and he has a legacy, let's call him a legacy accountant, that happens to look after this particular business that this query related to. But we were on the end of a call and he said, could I just pick your brain for a minute? And basically he's trying to sell the shares that he owns in a business, and we got onto the topic of SSE, and I told him that SSE wouldn't apply, which meant that he would have a tax bill. So we're going to talk about SSE today, what it is, why it applies, and why you need to be aware of these types of things before you consider having a group structure.
Okay. And what about are you also going to cover if you already have a group structure and you haven't considered this? Is that another aspect?
Well, yeah, but I mean, the horse is bolted, so...
Okay. Oh, right. Okay, so you can't sort of come back with...
I mean, there are a few things that you could do, but yeah.
Right. So
SSE.
Yeah. First of all, what does SSE stand for?
SSE.
Because I just think it sounds like the energy company, Scottish something energy.
Yeah. So it's a substantial shareholding exemption.
A substantial shareholding exemption.
Some people may also, I think years ago it used to be called SSR, substantial shareholding relief. It's the same thing, essentially. Okay. And what it essentially means is that, say, for example, you're growing your company A, and it's going really well, you're paying tax on your profits every year, and then you want to sell the shares in the company.
Yeah.
If you have a parent company that owns those shares, then when the shares are sold, any profit on the shares itself becomes a taxable profit to the parent company. Okay. And I think the argument is that, company A has already paid tax on all those profits. And obviously, if you've got retained earnings in your business, why should you pay tax on them again just because you happen to have a group structure? So the whole logic is to avoid this sort of like double taxation sort of situation where the trading company is paying tax on all of its profits as it goes along. The more profits that company generates, the more valuable it becomes.
Yeah.
And then if the parent company wants to sell the shares, the parent company also has to pay tax essentially on the profit, because largely the value of a business is going to be defined by the profit that it makes.
Okay.
And the profit that it's got retained in the business.
Yeah.
So the logic is that essentially it's a double taxation. And so SSE simply says that if you meet the qualifying criteria, which there's 3 criteria that we'll go through, then the parent company can sell the shares and they don't have to pay any tax on it.
Okay, perfect.
In a nutshell.
Do you suspect that people have gone through this process in the past and ended up paying more tax than they should have done because they didn't know about this? Or do you think most accountants will catch it?
No, I think if you don't have a chartered accountant doing your books, I'd be very surprised if they've come across this. But I don't think that people understand the tax complexities of setting up a group structure.
Yeah.
And unfortunately, there is no right or wrong reason. Like when somebody says, should I put my shares into a group structure or not? It's like, well, that's like, how long is a piece of string? Because how old are you? Do you have other shareholders? Are we thinking about inheritance tax at this stage? How many other companies do you plan on having? What other assets have you got? Like, it's such a complicated question. And if you're not aware of some of the traps of something like SSE, we'll do another podcast another week on some of the traps of BADR and how that is impacted as well. But if you're not aware of some of these trappings, then you could accidentally, as my client did in this situation, end up with a group structure, which meant that they were going to end up paying loads more tax.
Right.
Because nobody had said to them when they were creating this group structure, what do you plan on doing with these shares long term? Yeah,
they didn't. Well, it's the most famous thing, which is they didn't start with the end in mind.
Yeah.
The same thing.
And sometimes you don't know the end in mind. And that's also fine. Sometimes you might say, do you know what? I've actually got no idea what I'm going to do with this business eventually. I might sell it. I might keep it till I die. My children inherit it. You just don't know the answer.
No.
And so therefore it's a case of, weighing up the pros and cons and saying, is there a significant difference in taxes versus the two? And if there's not, then it's not a tax decision. It might be a slightly different reason that you're making that decision.
Yeah. Got you.
Okay. So SSE essentially allows the parent company to sell shares in a subsidiary and not pay corporation tax.
Okay.
So people might be listening to this thinking, why has Claire just said corporation tax? And because you'd be thinking it's a capital gain, but capital gain is when you own the shares personally. Capital gains tax applies to individuals.
Of course, yeah.
So if a business makes any profit, even a profit on selling shares, it pays corporation tax.
Yeah.
It might still be referred to as a capital gain, but the tax levied on it is corporation tax.
The type of tax they use is always corporation tax within a limited company.
So if you've got a slightly bigger company and your profit goes over 250k, you're going to be paying 25% tax on that profit.
And you'd never have a situation where it was a different company structure like LLP or anything like that. It would always be limited company.
Yes, in this scenario, yeah. Okay. So the 3 criteria that you must meet in order for SSE to apply to you is that you must own at least, or when I say you, the parent company must own at least a 10% shareholding in the business.
Mm-hmm.
Okay, so you just need to have 10% shares. You must have held them for 12 months. Okay. And both the parent company and the subsidiary must both have a trading status.
And what's that mean?
Okay, so it just basically means you must be doing a trade.
Okay, they must be trading.
So for the vast majority of businesses, like an accountancy firm, an estate agency, an electrician, they're all trading businesses. You're doing something, trading of some kind. Where it becomes a little bit grayer is if the company holds assets. So something like a buy-to-let limited company, for example, is generally classed as like an investment company instead, because you're buying assets with the aim of them being a long-term investment rather than to buy and sell on. So that's where you've got to be a bit careful. Now, in almost all scenarios, the trading company is going to be okay because it's going to be a subsidiary. So the company that we're selling the shares in is almost always likely to be a trading company. It's very unusual for that not to be the case. Where it becomes a little bit grayer is the parent company, so the one that actually owns the shares. Now, that's a holding company, so that in itself wouldn't be classed as a trading company. But as long as it owns a trading business, it becomes classed as a trading group.
Okay.
And you're fine. Okay? Following me?
Just about.
Have you got any questions at this stage, Simon?
I guess the practical reasons as to why this parent company would be, like, what are the scenarios why this parent companies would, or why you would be selling these shares in these other companies? Like, what kind of things would come up to go, I need to sell some of my shares.
So, okay,
why would they, just as a working example?
Take like getting an investment in your company. You might be selling some shares to an investor.
Okay.
You might be selling some shares to somebody that's coming in to do a partnership with you.
Yeah.
You might have bought a company and, it just doesn't work in your portfolio anymore for some reason and you want to sell it off.
Fine.
So there's lots of reasons why you might be doing it. You also might have a business partner that you don't want to work with anymore, all of those types of things.
So you buy out, but you don't pay the tax on it.
Yeah.
Because of the way it's structured.
So I'm going to talk you through. I'm not going to we don't need to focus on the client or their type of business or anything like that. That's not relevant to the story. But what I want to go through here is what happened with this particular client. Okay. So my client owns a 50% shareholding in a business. Okay. Used to own the shares in their personal name and 18 months ago decided to put everything into a group structure.
Yeah.
Okay. So they transferred their 15% shareholding from owning it personally to it being owned by a parent company. Okay. Now, 18 months has gone by and they only own 50% of the business. And the other partner, nothing significant's happened, but they're both moving in different directions in their life at the moment, different business directions. And so he would like to essentially sell his 50% shareholding to the other business owner and walk away. And I said to him, unfortunately, in your situation, SSE doesn't apply. So he, firstly, met the 10% criteria because it was a 50% shareholding. He'd had them for 18 months, so that's more than 12 months, so he was okay on that front. But where he fell down was the trading status.
Okay.
And the reason being, because in order for the parent company to be deemed a trading part of a trading group, the parent company has to have more than 50%.
Okay.
And they only have 50% or 51%. So therefore, the parent company is deemed a passive holding company. And therefore, SSE doesn't apply.
Right, okay.
Now, there is actually a happy ending to this, because it turns out that this guy, the old accountant that was looking after this company, has essentially he's a really just shit accountant. There's no other way to put that. And he'd actually never filed any of the paperwork to transfer the ownership from this guy's personal name into the holding company.
Right.
And I checked on Companies House and I said, just double check that your accountant filed all this paperwork, because there's nothing on Companies House to show that this transfer ever happened where he gave the shares to the holding company, and it turns out he hadn't. So he actually still owns the shares personally, therefore he can sell them and claim business asset disposal relief.
Yeah.
So there is a happy ending to this one. But what I think this highlights is how at no point when this guy was saying to his accountant, I want to give my shares from my personal name to my holding company, nobody ever said to him, well, if you do that, if you come to sell the business, you're going to end up paying more tax.
I think there's just like a broader lesson here with everything. If you're going to do something, we always use this like 5-year thing, which is like, will I care about this in 5 years? You know, that type of thing as to whether it's significant or not. Well, actually, you know, when you're sort of like setting up another company or, you know, intertwining things together legally, actually, do you know what? That does fall into the camp of you are going to care about this in 5 years, because it's still going to be very much there and it's probably going to grow into a bigger thing. So actually, it just needs you to stop for a minute, take a bit more thought on it, and actually maybe get some specialist advice on it to say, before I do this, what are the things I need to think about, and make sure you get the setup right from the start. And I think there's a lesson there in everything in life, which is this, will I care about this in 5 years sort of framework that I kind of operate on a lot. And that does give you this indication as to say, do I really need to check that I'm doing this right?
Yeah.
Am I future-proofing against all the different scenarios that might happen, or as much as possible? And I think that's, you know, would have been the scenario with this, wouldn't it, if it done that?
And do you know what? It is so difficult, because the situation that this guy was in at the time, you know, building a group, et cetera, wanting to leverage the group to secure financing and things like that. From that perspective, this made the right decision to do it. And it might have been one of those scenarios anyway, where had he been advised on this, he still would have taken the same path, because he was like, do you know what? If I've got all the assets within the group, I can leverage, because he's got multiple businesses, which is why he wanted to create this group structure. And it might have made sense from a commercial perspective, and it might have led to more growth in the group overall, because he could secure more finance than holding the assets personally. So it's not saying that, oh my God, you shouldn't put your businesses into a group structure because of X, Y, and Z. It's like, absolutely consider putting your businesses into a group structure, but just make sure that you've got somebody that can advise you on all the different angles. Because if you've got an accountant that doesn't understand securing finance or investment, also they wouldn't talk to you about actually having a group structure could mean that you can secure more finance, and they would just be coming from a tax perspective. So you've got to make sure that you've got a tax accountant, you know, like a savvy broker that can help talk about the financing and things like that, and just an accountant that's a bit commercially astute and can pull it all together and say what's the right way forward for this business, not just looking at tax and not just looking at financing.
Excellent. So the summary to that is you need a savvy bee.
A savvy bee. Oh my God, yeah.
Which is the new chav language for Sauvignon Blanc.
Yeah.
But yeah, a savvy broker. Nice.
We were having a comment. That's a little bit of an internal joke. It's like we were having a conversation with your sister. And when we met, probably about 10, 15 years ago, we drank a lot of Sauvignon Blanc, didn't we? And it was like the go-to wine of choice. And now it's
like very mainstream now.
It's very mainstream. And
when people start calling it savvy bee,
savvy
you know
bee,
something's gone wrong.
And now apparently if you put chili in it, you can have a spicy savvy bee too. And yeah, it's just... we really are scraping the barrel with language like that, aren't we?
Well,
ruining a very good wine.
I hope people kept up with that, Claire. I think it might be one where, if it does apply to them, they might just want to reach out to you and clarify their situation, ask a bit more detail on it, because it's quite a complex area. But I think this is more about, like, if you didn't quite get the detail of it, don't worry. It's more about the principle of it, and that you need to go and seek further information.
Do you know what? This only really becomes an issue. So, you know, number one and number two, you can work out yourself. Have you held the shares for 12 months or more? And do you own at least 10% or more? That's really easy to work out. The number three, the trading status, that's where it becomes more difficult. So if you've got if you're not 100% shareholding, or if you've got multiple organisations, some of them might be dormant, some of them might be buy-to-let companies, that's again where you need to go and get that specialist advice. So it's number 3, the trading status of all the entities, that really makes the difference, and that's where you need to seek the specialist advice. So if you've got a group organisation, or you're thinking about setting up a group structure, just ask your accountant about the implications of SSE in the long term and whether your current structure would mean that SSE applies to you or not.
Excellent. Thanks, Claire. Well, let's move on to this week's Profit Cash Growth Extra then. So you've got one this week, haven't you, Claire?
Yes.
This is
when we've got new starters in the business. Really. Yeah. We basically set every single desk up with a docking station so that anybody can come into the office and sit at any desk, depending on what you're doing that day. But also it means that when you've got a meeting, you can go to the meeting area, you can go to the conference room, and you can literally just plug in. You don't need to take chargers with you. You know, every station is set up with a docking station, 2 screens and a keyboard and mouse. And it's just made a massive difference, particularly when we've got new people in the business this week. So we've had 2 new starters this week. And so trying to train different people on different days on different tasks, I've needed to move around the office a lot.
Yeah.
And it's just been much easier for me to just literally be able to take my laptop and go and sit next to somebody for the whole entire day without it just being this like backwards and forwards because, my charger's over there and I don't have a screen and I don't have a keyboard and stuff. So I just can't recommend that enough about how much easier that's made in our office in terms of being a bit adaptable and being able to work more cohesively as a team.
It's just making sure that all of your connections technology are the same everywhere. Like try and go the same everywhere. This is like this annoying thing about when they change like phone chargers and things like that and you can't use them everywhere. It just gets so annoying. So if you're going to be cohesive in your office, then have the same docking station to plug into every laptop. I mean, it's particularly pertinent for yourself with an accounting firm because I've never seen people with so many goddamn screens in front of them. It's slightly different in my world where all my team are just out with the laptop and they don't really do all that. But it's like, when you're plugging into this great big workstation and they're in different places and different height desks and all this stuff that you've got going on, it's really helpful. So
and so
great. So get docking stations and make sure they're always the same for every station.
It's important what you said about the laptop because I made a mistake and ordered a laptop and didn't check the drives, like the ports that it's got, and it didn't have a USB-C connector. And so all of a sudden that one laptop doesn't work with anything in the organisation. So that just went straight back and now it's USB-C on everything.
Great stuff. Well, thanks for joining us for another week's podcast. As always, if you feel like you may have outgrown your accountant and you'd like to work with Claire and the team at Profit Cash Growth, nip over to the website profitcashgrowth.com. On there, you can book a discovery call free with Claire. You can also get a free copy of Claire's book, Profit by Numbers, or any of the other resources that we give away for free on the website. And as always, if you can just share this episode with one business owner or friend, that would be fantastic. And we will most certainly see you again next week.